Good afternoon, students. Today we are going to learn about cost accounting. Cost accounting, first and foremost thing which we need to know is the definition of cost, costing, and cost accounting. See, these three words sound similar, but there is a major difference in them. So let's see what is the meaning of cost. Now, cost is commonly defined as sacrifice the resource for a particular thing. Sacrifice the resource means if you want to buy something, you need to give something from your pocket. So, whatever you are sacrificing to get an object or a thing, that is known as cost. Next, we have costing. Now, cost is a term, whereas costing is a process for determining the cost. It may be called a technique for ascertaining the cost of production of any product or service in the business organization. Whatever cost you are paying for buying a product, that cost some in some or the other way you need to determine what should be the value of a certain product. So the process in which you are determining the value of a product is known as costing. Next we have cost accounting. So like you have learned what is cost and costing, now we'll see what is cost accounting. Cost accounting is basically the next step of costing. It involves analyzing relevant costing data, interpret it, and present various management problems to management. This term is of utmost importance for the top management of any business. See, first we have seen what is cost, value of a product. Then costing, the process in which we are determining the value of that product. And then in cost accounting, we will analyze that how we can reduce the value of that product, how we can increase the profit of that product. Likewise, we'll do some analysis that is known as cost accounting. So let's see what are the classifications of cost. The classification of cost is divided into four bases. On the basis of behavior, first of all we'll see, that is on the basis of behavior, time, production and management. There are four bases. The first we'll start with on the basis of behavior. On the basis of behavior, it is fixed, variable and semi-variable. So fixed costs are those costs which remain fixed irrespective of the change in volume of output. As production increases, cost per unit of the fixed cost decreases. And as production decreases, cost per unit of fixed cost increases. Fixed costs are rent of the factory building, depreciation, salary of the office manager, etc. So yes, the fixed cost is it is a cost which is fixed in nature. Irrespective of the volume of the production, it will remain always fixed. When you are renting a room, let's say for example, you want to start a class. So in a room, you have rented it for 10,000. The seating capacity is 60 students. But if you are having only 40 students in your class, still you will be paying 10,000 as rent. If the seating capacity, if you are expanding it to 70, like you have put some additional chairs, etc., etc., still you will pay rent of 10,000. Irrespective of the volume, the fixed cost will remain same. But where in case variable cost, it will change according to the volume of output. That is, if you are hiring, if you are giving admission in your class for the students, if you want to give notes to each of the students, if there are 40 students, then the notes printing charges will be comparatively less. If there are 75 students, then the charges will be comparatively more. So depending upon the volume, the charges are increasing. That is variable. Now, what is semi-variable? Semi-variable is a combination of fixed and variable. That is, partially it is fixed and partially it is variable. Partially fixed means, for example, we'll take the example of your telephone bill. Telephone bill, to certain extent, if you are taking like postpaid bill, they'll tell you the plan is for 99 rupees, yeah, 199 rupees, whatever. So for that amount you need to pay fixed charges. After that, even if you are using beyond that, then you need to pay additional charges. So if you are using additional internet service, if you are texting more, if you are making calls more, Depending upon that, the charges will increase, but for certain level, the charges are fixed. So that is semi-variable. Now, on the basis of time, there are two types. One is historical, another is predetermined. Historical costs are those costs which are already incurred. It is past data. Like the product is produced, the expenses are incurred, and then now I am analyzing where I have went wrong. That is historical. Now predetermined is something I am making estimation. If I want to sell 10,000 units instead of 500 units, then what all expenses I need to incur in addition? How the expenses, where should be incurred more, where do I need to reduce it? Likewise, I am making analyze. That is known as predetermined. Next, on the basis of function. Now, on the basis of function, there are manufacturing, office, and selling and distribution. Function, manufacturing is nothing but it is related to factory. You all might be learned in your 12th standard final accounts. Yes? Final accounts, if you remember, we used to post some expenses in trading account and then some in P&L account. Why we are posting certain expenses in trading account is because all those are related to manufacturing, all those are related to factory expenses. So all those expenses are classified as manufacturing overhead. So this depends upon function. First, you have to produce something, and then we'll do some admin things on that. Admin things like we need to maintain files, we need to maintain accounts of it, all the documents need to be verified. All those things will come under office overheads. Then there will be selling and distribution. Once all the things are calculated, everything is done, packaging, etc., then we'll go for sales and distribution. Now we'll get the order, we'll do some advertising, we'll give some free samples, and then we'll sell the product in the market. Next, on the basis of management. There are many, we'll see one after the other, but for the time being, I have taken only two expenses. One is normal and another is abnormal. Normal is that which you have estimated, you know such expenses will occur. Scrap. I know there will be some wastage. If I am producing 50 units, I know there will be 2 3 units will be scrapped. So that is what estimation you're making, those are normal. Now, abnormal is all of a sudden there is a very low demand in the market, so you could not sell all of your products in the market. So that is something abnormal which has gone beyond your control. So these are what abnormal expenses. The normal are which are there in your control, and abnormal is which is beyond your control. Done. So there are many other management things which we'll see those things in later presentations. Thank you.